Journalizing, taking the information about the transactions and recording it in the accepted format. There are 3 steps or more to journalizing a transaction. The first is to decide which accounts are affected and what type of account is it. Next, decide if those accounts increased or decreased. Then you're ready to record the transaction in the journal. The next slides go through the transactions we just looked at, only now we'll put them all into the correct format. The first thing that happened was the business sold stock and received money, so the 2 accounts are cash and common stock. Step 2, both increase. The company now has more cash, and the common stock account has also increased because there's more stock sold. The common stock account shows how much has been sold, not how much the company might have lying about. Step 3, record this. Debit cash, credit common stock. The journal is the book of original entry. It's the first stop, but not the last. We record everything in the journal and then sort it out into the ledger. Each account has its own ledger page. To actually create the journal entry, you want to think about the first 2 steps. We determined that cash and common stock both increase. Cash is an asset. Assets are on the left side of the equation, so assets increase on the debit side. Common stock is an equity account on the right side of the equation. It will increase on the credit side. The journal entry is shown here. We start with the transaction happening, then we analyze it, record it in the journal, and finally post it to the ledger. The next series of slides goes through each one of the transactions we did previously. We've already done the first one. The company paid cash for the land. Cash is an asset, and it's decreasing. Land is also an asset, and it's increasing. Excuse me. Both are on the left side of the equation. We'll show the increase in land with a debit and the decrease in cash with a credit. The company purchased supplies on account. Remember what I said about that phrase, supplies are an asset, which are increasing. You know that you have to increase an asset with a debit. It follows that the other side of this entry has to be a credit, because remember, they have to be equal. What account is it? Accounts payable. The bill will be paid in the future. The company performed services and received cash. Here's a hint. If you know what happens to cash, you've got the journal entry figured out. In this case, cash increases. Cash increases on the debit side, so the other account affected must be on the credit side. In this case, it's revenue. Revenue is an equity account, so it increases on the credit side. The company did some work on account. Remember, that means that money will exchange hands later. What do we call it when the company will get paid later? Accounts receivable. That's an asset account. They did work. That's revenue, an equity account. Debit accounts receivable, credit revenue. It's still revenue, even though they didn't get paid yet. The company paid some expenses. You know that cash decreased because they paid. Expenses are on the equity side, and they decrease equity, so you're going to show that with a debit. If that gets confusing, remember that you're decreasing an asset, cash, and that has to be a credit, so the expense has to be debited. The company paid the payable from the supplies. Cash is going to decrease, and so is the liability account. Decreases in liabilities are shown with debits, and decreases in assets with a credit. The owner remodeled her home. Still no entry required. The company got some money. Yay! Cash increases, and we know that's a debit. Accounts receivable decreases. An asset is decreased with a debit. The company sold land. An asset, cash, increases. Another asset, land, decreases. The company declared and paid a dividend. We're going to get into dividends in more detail later in the course. For now, realize it's an equity account and it's decreasing equity in the same way that expenses do. Cash is always also being decreased. Debit dividends and credit cash. After all of the journal entries are completed, each individual account is updated, and this is what they would look like as T accounts. On the line.